Hi everyone and welcome. It's Steve Johnson here, Chief Investment Officer at Forager Funds Management, and I'm joined in today's video by our International Fund Portfolio Manager, or Co-Portfolio Manager, Gareth Brown. Hi Gareth, how's it going?
Hi Steve. Hi everyone.
I noticed no bookshelf behind you today. You're joining us from a different room. Spent a big chunk of the last couple of weeks moving houses, always a pleasant experience.
Oh God, don't get me started. It's been nice to get back to work.
It was a busy week in the office as well with the quarterly report going out, and it's been a really, really good period of performance for both funds. Our Australian fund's actually up 75%. No, it's not a typo, it's 75% since the end of March, and I'm sure people that are invested in it remember it was a pretty significant drawdown into that as well, but now ahead of the market over the past year, nowhere near as much as the international fund though, Gareth, which has posted a very strong 12-month period now of something like plus 27%. What is driving that significant outperformance?
Well, stocks are going up.
That's the aim, isn't it? Buy low, sell high.
That's the simple answer. I mean, there's a lot of factors at work. It's been a very widespread of things that have been working well. So, you know, we put up some numbers in the 12-month 30 June where there was 3 big stocks that provided a lot of the outperformance. I think since then we've had a much wider spread over the last 3 months where we've done really well. I made a comment the other day to you that I don't think we've ever seen so many quick doubles in a portfolio. So it's newer ideas that are in the portfolio that are doing really well. Take, for example, you know, Fathom and Open Lending. These are 2 businesses that were both new to the market. They didn't have an established, knowledgeable shareholder base. So it was there for the taking if you did the work, not terribly complex to understand them. But if you did the work, you were among a handful of people who I guess, knew the score. And both those have sort of doubled since we invested in them a few months ago.
And you and Harvey have done a very good job, I think, of aggressively managing those portfolio weightings. People might not be too happy about it come tax time next year because, you know, we've had to realize some significant short-term gains there, but, you know, would rather be doing that than being overly exposed to something that has moved dramatically and in some cases even above our estimate of its fair value. I think one other thing, and this has been true in both funds, particularly in our Australian fund as well, but when you go through an environment where opportunities are abundant, it's so much easier to cut those things that haven't been working in your portfolio. And, you know, we've done that in the Aussie fund with things like MRM that are still trading where they were back in February and March. And we've put that capital into businesses that are up, you know, many times their purchase price from the time. I think that discipline needs to be there in healthier markets as well. This thesis is not working, but I think it helps when you've got really exciting things to do with the money. And we've done that with a few things in the international portfolio as well.
And the conveyor belt's going along nice and quickly and you're getting new ideas on there all the time. It's a sort of Darwinian process, isn't it? You need to fund good new ideas. They're working well. You sell some of your, I guess, problematic stocks more in, or you might struggle to make that decision in more normal times.
I said to Alex Shevelev yesterday, Gareth, as you pitched a couple of new ideas to me, this investing game, it's usually most profitable when it's most simple. You know, the ideas are not difficult to explain. You're buying some decent quality businesses in the Aussie market at the moment for single-digit multiples, and I think you're going to earn very healthy dividend yields in some of those stocks. I mean, that you touched on recycling, but what sort of areas are you finding new ideas in for the international fund?
Yeah, sure. So the areas that have been very productive over the last few months are things new to market. So we've seen the rush of listings through IPOs and SPACs, and we've taken advantage of like a very small percentage of that sort of stuff. We've picked our targets. We've done really well. Personally, I think that opportunity is probably closing at the moment. And we want to be really careful around that because, you know, environments where everything you touch turns to gold make me nervous. What I find really interesting here is that we have a bifurcated market still. And if I bring in a historical analogy, the 1999-2000 period, that was a time where you had this crazy tech boom, but there were plenty of cheap value stocks and places to hide. Whereas in 2007, like the whole world was a bubble and there was nowhere to hide. And I feel this is much more like the 1999 period. We have things like Vienna Airport. Now, of course, COVID is absolutely hurting them at the moment. But this is a business that's generated like 150 to 200 million euros of free cash flow a year going back 4 or 5 years, closer to 200 million last year. It's trading at a 1.8 billion market cap. It's a north of 10% free cash flow yield on an or basically ungeared asset. If the future looks anything like the past, we'll do really, really well from here. And we're trying to find things like, or I'm particularly to focus on things like that will present a different risk reward profile, I guess, than some of the things that have been working really well in the last 2, 3, 4 months.
I guess you touched on it a little bit there, but you tweeted something pretty interesting over the past few days. It was a Joel Greenblatt quote about just buying, well, it was big market cap businesses that were loss-making has been the recipe for success over the past 12 months. Now, what does that mean for overall market returns from your perspective?
I'll read the quote. He said, if you bought every company that lost money in 2019 that had a market cap of over $1 billion US, and there are about 261 of those companies, if you bought every single one of those in an equal weighted portfolio, you'd be up 65% so far this year. So all of us fund managers struggling for, well, claiming victory because we got 27%, whereas you could have just bought the losers and done 65 in US dollar terms. It shows the bifurcation here. Well, I mean, we have the winners are doing really, really well, and then the tech growthy loss-making companies are also doing extraordinarily well. You look at the MSCI index over the last 12 months, it's flat. It's a 3% gain. So, you know, on one hand, you've got a smallish subset of companies absolutely killing it. What's the rest of the universe doing? Well, it's clearly not going up.
Yeah, and I think that's true in the Aussie market as well. I mean, the whole Aussie market's still down, well more than 10% from its peak. And within that, you've got the same dynamic going on. So there's still plenty of businesses down there that are trading at pretty significant discounts. And you know, that return, we've been going 11 years in that Australian fund. The return since inception is less than 7% from the market, including all of your dividends. So you've probably had a 4% yield over that period and maybe 3% capital growth. It's not crazy bubble pricing, I think, across the whole market. And that makes me pretty optimistic, about just future returns from the Aussie market from here. And yeah, I think generally stock markets around the world, and then our ability to add something to that at the moment because of that bifurcated market is quite good.
And I think if you just came and looked at it afresh at the portfolio of cheap value stocks that we have in Oz, you'd say they're very cheap. Like, it was just an extraordinary time that they halved and now they've rallied 75%. But you come at it fresh, those stocks are quite cheap versus any sort of historical norm.
Yeah, Alex has written about that. I mean, they're actually delivering results that are a bit better than what we'd anticipated when we bought them prior to the crash and thought they were cheap at that point in time, and they subsequently halved and have come up a lot. And like I said, I think we've been able to rebalance that portfolio a lot as well into a better quality of business. And a few of those things, like a Thorn Group, for example, announced a big fully franked dividend last week. That is a sign that we're actually going to see some of that cash back from those investments. But the quarterly report's up online, so jump on there and read it and register for future updates if you wish. You'll see when you read my cover letter, it's been a very volatile and stressful year for the team, and I'm really, really proud of what we've achieved, not just in terms of returns for investors over that period, but the way that we've worked together and come through it as a business as well. It's taken me a bit of time, I think, to recognise that. It's just been so frantic, and we've been running around dealing with the day-to-day, but it was nice to write a quarterly report and look back at 9 months where I think the team has functioned very well and added a lot of value to our clients in a very difficult market. Thanks for tuning in, and we'll see you next week.